Apart from Brexit, US-China trade talks, the global slowdown, the potential for a recession, and of course maybe Fed cuts. One of the surprising themes for 2019 is the state of global market volatility, or the lack of it. Look across the various different ways of measuring it. It's low, very low. But low volatility in itself is not necessarily a bad thing, but we do need to take account of two aspects. First, it can lead to excessive risk-taking. And the second, of course, it can lead to looser investment standards in that quest for yield. So just think back to last year's VIX spike. We saw the XIV crash. Or how about the Italian election results and the widening Italian BTPs that we saw? So to ask the question, how long can this last for? We need to first ask the how and why we got here. The first, of course, is looking at the here and now. As the current state of global macro volatility, it's very low when it comes to economic indicators in terms of the differences between countries. The second, though, is more of a structural phenomenon over a multi-decade period. But let's look at the first, the here and now. 2019 has sure got off to a much better start than how 2018 ended. If markets in December were expecting a Santa rally, they really disappointed. We witnessed a 16% high to low in US equity markets into the year end, and financial conditions tightened in a fashion that warranted action or at least some comment from policymakers. The extremity of the market moves saw the pricing of a US recession over the next 12 months rise to a high of 40%, depending on your preferred model of measurement. The power of hindsight means that we can deliver the good news, which is the market's immediate recession pricing. It is lower now, but it is still at an uncomfortable level. So given how poor the end of 2018 was for markets, it's set a low bar for 2019 to beat it. The past few years of new year expectations becoming wrong-footed within weeks and months of the year's start highlights just how difficult it has been for markets to forecast the future. Just like how 2018 wasn't the year of Goldilocks that most expected, with high expectations of high growth and low inflation, 2019 has not been the quick turn into recession that markets feared either. Just take your pick of major global equity indices and it's green across the board for year-to-date returns. It shows that a lot has taken place over the past 3 months or so, but rates vol, equity vol, and foreign exchange vol all are near their historical lows. What we initially saw in just a few range-bound markets has become applied on a wholesale scale. It's being driven by this halfway house view that's emerging. What we've seen so far is a market that has lowered the recession risk pricing that we saw in December last year, but also a market that says growth won't bounce back materially either. That view feeds through to central bank pricing. The market that has witnessed the United States Federal Reserve react in their recent comments to the recent tightening in financial conditions and prices that they may even cut rates over the next 12 to 18 months. But to frustrate things further for volatility markets, the market is much less sure than it once was on that negative view of things for where growth is going, especially given the recent monetary and fiscal stimulus efforts in China, but also the dovish and recent forward guidance by both Fed and ECB officials. Forward guidance. This is the part of the central bank toolkit that really has taken the wind out of long volatility trades. As central banks found themselves at the lower bound of how far interest rates could be cut, they took to strong verbal commitments of how long their interest rate policy would be held for, and also increased their efforts of transparency with both the market and broader public for where rates are likely to go next. This lowered the uncertainty as to the timing and the direction of interest rates. It was necessary during times of crisis, but it has led to the state of low interest rate volatility that we see today. But that's just the past few years or so. What about the structural factors? Well, market volatility isn't always low. It does spike higher from time to time. But the odd thing is that those spikes do not seem to last as long. Each spike, it's got its own story. That eventually resolves itself. But the volatility does tend to mean revert back towards the historically low levels much more often than we were used to. So why is that? Two factors at play is the first, globalization. We have to remind ourselves that the market prices are relative. A share price rising is also saying the same thing as the value of the dollar against that share is falling. In foreign exchange markets, It's the same concept but on a countrywide level. If both countries face the exact same economic pressures, what is there to say that the value of their currency versus the other should be any materially different? In practice, those economic pressures, they're rarely exactly the same as each other, and currencies therefore move as a result. But one structural trend that is likely to go away is the high level of globalization tying economies to each other and to the global environment as a whole. World trade in goods and services has reached 29% of world GDP. It's no wonder that the differences in growth rates between countries are not as wide or different as they used to be, and this is broadly reflected in the high levels of correlations between global interest rates too. This is what has been contributing to the second factor, which is the lower volatility in the global economic data itself. When the US slows down, Europe tends to slow down as well. It's hard to argue using the growth and inflation frameworks that are the bread and butter of foreign exchange analysis to say why the dollar should weaken when the Eurozone is facing the similar headwinds. So with it, we come to the conclusion that markets are in this halfway house between one another, and volatility has fallen with it. So to answer the question of how long this could last for, we need to ask what could send volatility higher. The politics in Italy, a no-deal Brexit, US-China trade talks falling apart, or grey swans such as a debt bubble popping in China are all valid candidates. But as we've seen over recent years, those political headlines see only short-lived spikes in volatility that within days and weeks tend to resolve themselves quickly and have had a low cross-market contagion effect. So what would really move market volatility is twofold. The first is for central bank pricing to move, and preferably to diverge from one another. With the ECB at or near the zero lower bound, it's required a conversation about tiering interest rates that would allow more flexibility to respond to the downturn. But until we get a decision there, the relevant monetary policy is more likely to be driven only by the US leg of the equation, which already prices in 1 to 2 cuts over the next 2 years from the Fed, and on its own probably won't be enough to warrant a spike higher in volatility, as we're already seeing. The second could be the big recession trade, but the big recession trade is a curve steepening, not a curve inverting. And when the curve does steepen, so with it will be FX volatility. It's when the market turns from pricing a slowdown in the US economic cycle into a recession that we will get the real spike in volatility. Steeper curves, asset prices at distress levels, and central bank government actions varying from one another would create enough uncertainty as to the direction of markets. We're not calling for a recession in the US, but we can't help take note that it's probably not long until the US 2's 10s curve will eventually invert, and it's historically been the market's best forecast of a recession to come. So low volatility, it's not necessarily a bad thing. In fact, it's a defining characteristic of what we call the good times. But it can equally lead to asset price bubble valuations and mispriced risk in markets that equally result in remarkable drawdowns when volatility does rise again. But if there's one thing that we can say is that when vol does rise, the good time low vol regime that we've experienced, it may seem like a distant memory we'd like to go back to.